Hey guys, and welcome to the second video for chapter 4, which is relevant costs for decision making. And in this video, I'm going to be covering the final two decisions that you may have to face, and I'm going to be doing a question where you can apply some of the concepts that you've just learned. So in front of me, I have a resource constraint decision. Now, when it comes to this, it's usually when you're facing a constraint in a certain aspect of an ingredient that goes into the product, and you really don't have enough of it. So you have to decide where to allocate that constrained resource and how to allocate it. All right. So how you do that is based on contribution margin per base activity. Now, what that even means, it sounds so confusing, but it's very straightforward though. What that really means is that you're trying to find out how much contribution margin is each product contributing based on the constrained resource. So I've drawn out an example here, all right guys? So you have product A, B, and C. Product A has a contribution margin of 5, B has 8, and C has 14. Usually, in normal circumstances, product A takes up 50 kilos, B takes up 70 kilos, and C takes up 100 kilos of direct materials. And overall, like producing as many units as you want for all of these products, the total number of kilos required in direct material is 120,000. But hang on, to this year, you have an issue, all right? This year, you only have access to 50,000 kilos. That is a problem now because you really need 120,000 and 50,000 is available to you. What would you do now? What is your next step in this case? Well, now you have to find the contribution margin per base activity. Base activity basically is the constraint resource. So in this case, what is that the right spelling for constraint? That is, yeah. So in this case, what is the constrained resource? It's direct materials, right? So now what you have to do is divide the contribution margin for each product by the direct material that each product takes up. So I'm going to come up with 3 different numbers. So the first one is 0.1, which is 5 divided by 50 kilos. The second is 8 divided by 70, so that's 0.1142. And the last one is 14 divided by 100, so that's 0.14. Now guys, out of all 3 of these numbers, which is the biggest? 1, 114, or 14? Well, this is the biggest number, right? So this is your number 1 priority. What's after 0.14? This 0.114, right? So this is your second priority. And what's last? 0.1, right? So product A is your last priority. Oops, sorry. That should be a 3. Product A is your last priority. All right, so this is how you prioritize, and this is how you essentially rank your products. So this 50,000 now, you're going to allocate in this order. First, you're going to give you're going to make as many units as needed for product C, because that's your star product, that's number 1. After that, if any kilos are left over, you're going to produce product B. You're going to produce all the units that you can for product B. And then even after that, even still, if some kilos are left, you're going to produce as much as you can, whatever you can for product A, which is your like last priority. All right, so that is how you handle a resource constraint question. Moving on to the last one, and I'm not going to spend a lot of time on this because it's very easy, which is a sell or process further. So in this case, you want to decide whether you want to sell your product in its raw format or if you want to process it further to make profits. But the question is, are you really going to make more profits just by processing it? So maybe you have like cotton. Sorry, that's the best I can do. And Then you have like a t-shirt. Doing my best here, guys. That's a t-shirt. So you want to essentially decide whether you're going to make more profits if you sell the cotton as a t-shirt or if you sell it as is. So you want to do a market survey. You want to see whether you're going to make more profit or not. You want to really know your costs beforehand. So like as any profit maximizing firm would do, like if your profit is greater by processing the product further, then go for it. Yeah, you're going to sell it as a t-shirt then. But if it's not feasible to do so, then you're going to sell it the way it is, as plain cotton. All right, guys. So now we're going to move on to a real question, which is a make or buy question. So it's Caleb Shoes manufactures and sells shoes, blah blah blah. The information is given to you. And this other company has come up and said, hey, we offer $15 to produce your shoes for you. And then you want to compare that price of $15 to your own price. So you have direct materials of $5, you have direct labor of $3, variable manufacturing overhead of $2, fixed manufacturing overhead, which is traceable, of $8, and fixed manufacturing overhead allocated of $4. The total comes out to $22. Now, just by looking at it, is this a good option? Shouldn't we just buy it from the other guy? Like, he's giving it for 15, whereas your own costs are 22. The obvious answer is yes, we should totally buy from this guy, and we should forget all about, like, we should be ashamed of how bad we are at producing our own product, right? But it's actually more complex than that. See the asterisk? There's always an asterisk, right, guys? So you want to read that asterisk and you want to see how to really dig into this question. So the first part where it asks you is assuming there is no other use for the space used. Basically, this question is saying assuming that there is no opportunity cost, basically, all right? What is the net dollar advantage or disadvantage of accepting the supplier's offer? So I'm going to draw this up, all right? It's better to illustrate it. So you can either decide to make it yourself or you can decide to buy it, all right? And we're going to look at each aspect of it. So if you make it yourself, your direct materials are straight up $5 per unit, right? These are per unit figures, so $5. And if you decide to buy it, then you have no direct material cost, right? Again, on to direct labor. Your direct labor is $3 if you make it, and you don't have any direct labor if you buy it because you get it like wholly, right, in your hand. Variable manufacturing overhead, again, that is only if you decide to make it, but not if you buy it. Fixed man. Now this is where the fun begins, because this is where the asterisk is. Now let's read the asterisk. Half of the fixed manufacturing overhead relates to equipment maintenance, and half of it relates to depreciation of specialized equipment. Now remember, guys, in the first video I said that only relevant costs go into the decision-making mix, and you ignore any costs that are unavoidable, right? In this case, what do you think is an unavoidable cost? The half and half. What do you think is an unavoidable cost and we should totally ignore it? Well, it's depreciation of specialized equipment. Depreciation is something that you cannot run from, right, guys? So it is something that happened like at the start of the year, maybe, because depreciation is something that just happens. You don't pay out money as depreciation, like, here you go, who are you going to pay it to? Like, it just happens, right? Your assets get older and then they have lower value at the end of the year. But equipment maintenance can be controlled, right? If you don't have that equipment on your, like if you're not using the equipment, you're in no need to maintain it, are you? So equipment maintenance is indeed is avoidable, and it is relevant to this decision. So only half of the 8 is going to go into our decision. So fixed manufacturing overhead, which is traceable, is only $4, right? And finally, we have fixed manufacturing overhead, which is allocated. Again, I'd like to explain this in more detail. So think of your factory like this box or whatever, all right? And you have 4 departments in it, and you pay a total rent of 12, actually I don't want to write it so close to my calculations. You have a total rent of 12,000, all right? And you equally distribute that rent into 4 parts for each department, right? Because everyone should pay up equally. So your rent is divided into 4 parts. Now imagine this is the department that Caleb's Shoes manufactures and sells shoes in, right? If they decide to buy from the outsider, this place will become useless because it says in the question, assuming there is no other use for this space. This space is going to become useless, all right, guys? But the fixed overhead is still going to be there. You're still going to have to pay $3,000 of rent for that space, even though you're not using it. So that sort of fixed cost is unavoidable. It's a sunk cost, and you have to pay it regardless of what you do, right? So this $4 it's unavoidable and it's irrelevant to the decision. Therefore, you ignore it. So I'm going to draw the line here. So if you buy it, it's $15, the straight out price that the outsider gave you. But if you decide to make it yourself, the total comes out to $14. Now do you see? Had we decided to go with the supplier, we would be actually we would be losing out because we're making the product at $1 less than what the supplier has offered us. So and we're doing great, to be honest. And there is no need to buy it from an outsider. All right, so you're doing great. You don't need to actually shift to this guy and rely on him to make your products for you. On to part B. If the offer is accepted, the company could use the space to develop a new product line that would generate estimated margins of $25,000. Now there you go. That's your opportunity cost. That is something that you can use the space for. It's something else that you can use the space for, should the company accept the supplier's offer. So it's gonna be the same drill. I'm gonna draw up make and buy, and we're gonna see what the decision, if it's favorable to buy or make it ourselves. So DM, DL are the same, right? If you're gonna make them, DM and DL are gonna stay the same. It's $5, and this is 3. This is nada. And the variable MOH is also the same, 2, and this is again the same. Fixed MO, actually, yeah, all of these are the same. I should have just copied. Anyway, so opportunity cost. This is the only difference that we have, in part B. So for this part, a total profit margin is given to you, 25,000, right, guys? And over here, it says, during a normal year, Caleb's Shoes manufactures and sells 10,000 shoes. So you want to find what your opportunity cost is per unit, because we're calculating per unit values here, right? So it has to be, all of it has to be in the same format. So you want to divide 25,000 by 10,000 to arrive at $2.5, right? So $2.5, that's your opportunity cost. Now let's total them up and see what we get. So this is 15, that's the quoted price. And let's see what we get on our own. 5 plus 3 plus 2, 4, 2.5. That is 16.5. See how the tables have turned now. Now, it would be more expensive for you to make the product yourself rather than buy it, because you have an opportunity cost now. You could make 25,000 bucks if you sold this, if you started buying it from someone else and you gave that place off to make $25,000 in a new product. So as you can see here, how the decision has changed. First, it was a good decision to make it, but now it's a good decision to buy it. So that is essentially how you make decisions based on monetary values. Other things that you can consider are like the ones that I suggested in the first video. So these are the quantitative and the qualitative aspects of how to make a decision such as this.